What's going on, everyone? This is Aaron from Penthouse Finance, and welcome to the video. In this video, we're talking all about financial leverage and how it's the most powerful wealth creation tool. I also wanted to mention that this is the first video on our channel, so for anyone who's newly watching, for any of our new subscribers, thank you so much for supporting us on our journey to bring you guys interesting, exciting, informative, and educational videos when it comes to finance and all that other cool stuff. So in this episode, we're talking all about financial leverage. So what is leverage? So what is leverage? Let's explain it in its most simple form, or something that you guys can relate to the easiest. Leverage is when you put 5% down on a property. You know, you buy a house, you put 5% down. Let's say the house is $500,000. So you'd have to put $25,000 down to buy a $500,000 house. Let's say you're in a good market and house values are increasing at about 5% per year. So the value of that house is also going up by about 5% per year. Yet you've only invested $25,000. So in a sense, you're using 5% to buy an asset that's worth 20 times what your initial investment is, and then that asset is appreciating based on the total value, which is $500,000. So in a sense, you're achieving 20 times leverage, and if that house goes up by 5%, which is pretty reasonable for many real estate markets, in 1 year, you've essentially doubled your investment. Now that's just one example of how using financial leverage can actually build and create wealth at a very rapid pace. But at the same time, it also works in the opposite direction. So let's take 2007, 2008, for example, when people were buying properties right before those housing prices crashed. If you were to put 5% down on a property, once again, let's say it's worth $500,000. Then the market tanks, your house goes down by 50%. Now you're left owing the bank $250,000 if the value dropped by 50% minus the initial 5% you put in. So financial leverage is like a double-edged sword. You can use it to make a lot of money, but at the same time, if you end up losing, then you lose a lot more than your initial investment, which is not good. So guys, we're going to talk about a very interesting topic right now. And that topic is called cheap money. For anyone who's looked at the stock market, glanced at the chart, maybe let's say for the S&P 500, we can see that the markets have just gone up pretty much steadily with a few hiccups for the past 10 years. It's the longest bull market in history. And many of us might wonder, why has the stock market just continued to increase? And that's for the simple fact that when the stock markets crashed in 2008, what the central banks did was they lowered interest rates in order to, stimulate the economy. They also printed money, and pretty much money was easily accessible for a very low interest rate, which means that rich people, they're like, oh my gosh, there's so much free money out there, or pretty much free money. We're just gonna invest it into the market, we're gonna invest it into the economy, we're gonna buy up real estate, we're gonna buy up assets, we're gonna borrow this money at a very low interest rate, and then just generate massive amounts of returns. So cheap money is what's pretty much driven the economy for the past 10 years. Anyone who's invested in real estate in one of the major cities, anyone who's invested in the stock market, even a broad index fund has done very, very well thanks to lower interest rates, monetary stimulus, lots of available capital at a very low interest rate. So now we're going to show you guys how financial leverage can create wealth without having to actually invest a lot of money. So let's take a personal story, for example. So when I was 20 years old, I wanted to buy my first property. I always thought that real estate was going to be a good investment, and I thought to myself, what's the average net worth of, let's say, a family? They've got some investments, they got their job, little savings account, and then their house. Their house always stood out as being the best investment to me. I always asked my parents, what did you guys pay for your house? And it was always lower than what the values were today. So coming from a simple mindset, I thought, wow, house prices, they just seem to always go up. So when I was 20 years old, after working for 6 years at a grocery store, saved up about $25,000, and I was like, you know what? Now's the time to start to take a look at some real estate, start to buy a property. And I didn't know much about the market, I didn't know much about investing, but I did hear that you could rent out the house as well. So living at my parents' house, let's buy a rental property. So we had $25,000 saved up. So we had $25,000 saved up. So how much money did I need to actually buy a house? Well, back there in 2012 when real estate prices were still pretty cheap, the average townhouse was only $250,000 in my specific city here in Canada. So I said to myself, how am I gonna buy this house and how much do I actually need? So you need 5% down in Canada as a first-time home buyer. So how much money is that? In terms of $250,000, we're looking at about $12,500 plus lawyer fees. I believe that land transfer tax was included as a first-time home buyer. You get a first-time home buyer's credit. So all in all, for about $15,000, I ended up closing on my first investment property that was worth $250,000. Now let's fast forward 7 years. So that initial $15,000 investment on that $250,000 townhouse, now the townhouse is worth very close to $500,000, but we'll just put $450,000. Now over the course of those 7 years, the property appreciated by about $200,000. Now remember, that's on that $15,000 initial investment just into the down payment. If you were to invest $15,000, let's say in a bond, in a savings account, or in the stock market, it would take you an insanely long time to 13 times your money, which is essentially what $200,000 is from $15,000, not to mention every month the tenant pays a rent, which pays off your mortgage, which adds more equity into the house. So the number is actually higher than $200,000, but we're just using that as a simple, easy example of how using financial leverage can generate a massive amount of wealth with not a lot of money. Now don't get me wrong guys, you need to get approved for the mortgage. There's many different things when it comes to real estate, many risks, many costs. It's not an easy business, but it is a business where you can generate a lot of money using financial leverage. So once again, we're gonna reiterate a few points. Also, the downsides of using financial leverage. If you were to borrow that $15,000 in the form of a line of credit, you go out, you buy a property and the market crashes, not only have you lost your down payment, but the house has also dropped in value, so now you're actually what they call underwater, which happened to many people during the 2008 market crash. A lot of people bought properties, let's say for $400,000, values dropped 50%. Now they're in the hole for $200,000. They're paying a mortgage on a property that's worth half, and a lot of people just defaulted. They gave their houses back to the bank and they accepted the credit loss. So guys, that's it for the video. Let us know in the comments what kind of topics you guys would like to hear. We're gonna be talking about financial leverage, investing in real estate, the stock market, many cool different sectors when it comes to investing to look at. So thank you so much for tuning in. Smash that like button, hit the subscribe button, bell for notifications, all that good stuff, and we'll see you guys in our next video.